One hit and miss on the personal tax side. The government had introduced an optional new tax regime in the Union Budget 2020-2021 with lower tax rate but without a lot of the exemptions and deductions. This new concessional tax regime provided taxpayers the flexibility to choose between the existing tax regime with deductions and the new regime with lower tax rates and without a lot of the deductions. The aim of this new tax regime or concessional tax regime was to simplify the tax structure, reduce compliance burdens, and put more money in the hands of the individual taxpayers. While the concessional tax regime offered lower tax rates and did indeed simplify the tax structure, last year, to really encourage adoption, the government made some landmark amendments. The major tweaks last year were the exemption limit was increased from 2.5 lakhs to 3 lakhs. Standard deduction of 50,000 rupees for salaried individuals and pensioners were extended to this new tax regime as well. The highest surcharge rate for income over 5 crore rupees was reduced to 25% from 37%, thus reducing the MMR to 39% under the new concessional tax regime. The income threshold for rebate was also increased from 5 lakhs to 7 lakhs, ensuring that individuals with net taxable income of rupees 7 lakhs are exempt from paying any income tax. The government also introduced a marginal relief for small taxpayers whose income was crossing the threshold of INR 7 lakhs marginally. So I think this was a very, very big hit because this they really lived up to their promise of making the tax system more transparent, and also it was the West, as you see, also has a system where there are fewer exemptions and deductions, and therefore filing of tax returns and paying up your taxes becomes a little easier. At the same time, they did introduce SOPs by lowering the tax rates, but to encourage more and more adoption, maybe more tweaks need to be built in this year as well. One miss. In the Union Budget 2018-19, there was a rollback of the long-term capital gains tax exemption on equity exemptions. Prior to this, gains from sale of equity shares held for more than a year were exempt from tax. However, the budget introduced long-term capital gains tax at a rate of 10% on gains exceeding 1 lakh rupees from the sale of equity shares and equity-oriented mutual funds. The reintroduction of this long-term capital gains tax received mixed reactions from various stakeholders. While some considered it a big move towards a more equitable tax system, you're rationalizing the tax structure, bringing parity between different asset classes, some investors did express a lot of concern. So in the short run, we did see a lot of volatility in the stock exchanges, a lot of hue and cry in terms of the change in the mindset as well. I think that has sort of settled down. There is, of course, an ask year on year to increase this exemption limit from 1 lakh to 2 lakhs or more. But I think that, I may call it a miss, or I may call it a creation of an equitable tax system, but it is something that people still talk about as to why it was introduced, because it was a change in the whole system of taxation of long-term capital gains. Thank you.
Stay with the Times of India for news breaks, analysis, interviews, and events. We bring you stories from your neighborhood and from across the globe as well. Subscribe to our YouTube channel. Hit the like button and press the bell icon so you don't miss any of our videos.